Imagine sitting on $73 billion of guaranteed business. Like,
Quite a
guaranteed.
staggering number.
Right. I mean, Broadcom, which is ticker symbol AVGO, is a company at the absolute center of the artificial intelligence boom. And they're holding a backlog of orders so massive, it literally rivals the GDP of some countries.
Yeah, it's really hard to wrap your head around that kind of scale.
It is. And, the stock recently closed at 398.47. Which is just a breathtaking climb. But, and here's the catch, if you look at the critical momentum indicators right now, Wall Street's dashboards are flashing this bright neon warning sign that says overbought.
Right, the sell signals are definitely blinking.
Exactly. So is this tech giant a strong buy, like just catching its breath before launching even higher, or is it sky-high valuation and this falling trend we're seeing, this short-term overheating a massive value trap, waiting to snare retail traders who are showing up late to the party?
Well, you are looking at one of the most fascinating paradoxes in the market right now.
How
Because we have these fundamentally historic financial numbers colliding head-on with, well, technical gravity. I mean, when a stock moves this fast, the underlying data often tells two entirely different stories depending on whether you are looking at the next 3 weeks or the next 3 years.
Okay, before we figure out which of those stories to believe, I have a quick favor to ask you, the listener. Please like this video and subscribe to our YouTube channel. And honestly, it is compulsory to leave us a comment with your feedback.
Yeah, please do. We really want to hear from you.
We do. We actually read those comments, and they help us tailor these deep dives just for you. So, what is our game plan for today?
So the mission for today's deep dive is to filter out the noise. We are going to objectively analyze Broadcom's financials, unpack the underlying order flow, translate those technical indicators, and weigh the fundamental bull and bear arguments.
Basically give you the raw mechanics of what is actually driving this stock. And crucially, I want to make it crystal clear that this conversation is just a natural human debate. This is entirely educational. Absolutely no financial advice is being given here today.
Right, definitely not financial advice.
We are just two people unpacking the data so you can make your own informed decisions.
Because knowledge is only a weapon when you understand the mechanics behind it. So let's start by, lifting the hood on Broadcom's foundation.
Yeah, let's look at the financials. To understand if Broadcom is a trap, we have to grasp the sheer scale of what they have built. Let's look at the snapshot as of the market close on April 16th, 2026.
Okay.
The stock closed at $398.47, right? With a day range between 392.35 and 399.68.
Yep, hovering right below that 400 mark.
But to really appreciate that number, you have to zoom out to the historical context. I mean, the 52-week low for this stock was around $161.61.
That is wild to think about.
It is, and the 52-week high sits at 414.61, pushing its market cap to nearly $1.89 trillion. It's just been a relentless climb.
It has. And the income statement reveals exactly why the market has been so willing to bid that price up.
What are the quarterly and annual numbers looking like?
Well, when you look at the latter part of 2025, they posted a revenue growth rate hitting 23.87%.
Wow.
Yeah. But the number that really has everyone's attention is the 2026 projection. They are anticipating annualized revenue to spike significantly above $100 billion.
$100 billion in a single year. I mean, you don't hit that kind of revenue by just selling one popular gadget.
Not at all. That explosion in revenue is driven by a two-pronged strategy.
Yeah.
You have the massive wave of custom AI silicon they are building for data centers, combined with the synergies they're unlocking from their acquisition of VMware.
Right, so they're in everything.
Yeah, they have fundamentally positioned themselves at every choke point of modern computing.
I always think of Broadcom like this massive tech octopus, right? With tentacles in both hardware and software. It's like a digital toll booth.
That's a great analogy.
If a company wants to build a massive AI infrastructure, they have to drive on Broadcom's physical roads. That's the hardware, the networking switches, the custom chips.
Exactly.
But thanks to that VMware acquisition you mentioned, Broadcom also owns the traffic lights and the digital rules of the road. The virtual machine software that actually organizes all those servers. So they are taxing the physical build-out and the digital management.
And that dual revenue stream is exactly what generates their elite gross margins, which currently sit between 67.77% and 77%, depending on the specific non-GAAP adjustments you factor in.
Those are crazy margins for a company that makes physical hardware?
They are. They're extracting an enormous amount of profit from every dollar of revenue because they own both the infrastructure and the virtualization layers.
But let me push back and challenge that foundation for a second.
Yeah, go for it.
Elite margins and $100 billion revenue projections sound fantastic, but I'm looking at the balance sheet, and there is a glaring number right there, an 82.70% debt-to-equity ratio.
Yeah, that's a big number.
Right. I mean, they didn't build this poll booth organically. They financed it through aggressive acquisitions. So if you have that much debt weighing down the balance sheet, does a near $2 trillion valuation start to look shaky? Does that aggressive acquisition debt make the foundation a bit of a trap?
Well, debt at that scale always warrants scrutiny, obviously. But you have to look at the mechanism of how that debt is serviced. Look at the cash flow.
Oh, wait, break that down for us.
Broadcom's saving grace, and really the reason institutional investors aren't panicking, is their free cash flow conversion. When you have gross margins hovering around 77%, a massive percentage of your revenue translates directly into liquid cash.
So they aren't just logging revenue on a spreadsheet, like the cash is actually clearing the bank.
Yes, they borrowed heavily to buy assets like VMware. But VMware is an enterprise software company, right? And software provides high-margin, recurring subscription revenue.
Oh, right. Subscription.
Yeah, Broadcom essentially bought a cash printing machine on credit. Because the cash flow from the software side is so reliable, they easily service the interest payments on the debt.
While still having plenty of capital left over to fund their hardware R&D.
Exactly, and pay dividends. So the cash flow makes the debt highly manageable.
Okay, so the underlying business seems incredibly robust. But this leads to, like, a psychological hurdle for me.
What's that?
Well, if the fundamentals are so strong and the company is projected to cross $100 billion in revenue, we need to look at what the people on the inside are actually doing.
The insider selling.
Yeah. Between late March and mid-April of 2026, we saw key executives selling shares. Ram Valaga, the president of the ISG Group, and director Justine Page both sold off stakes at prices floating between $352 and $370.
And that is a data point that often triggers anxiety for retail investors watching the news.
Because it feels totally contradictory. I mean, wait, if you are a top executive and you know there is a $73 billion AI backlog waiting to be fulfilled, why are you cashing out in the 360 range right before the stock nears 400?
It's a fair question.
The natural fear for an everyday investor is that the insiders know something we don't, and retail is about to be left holding the bag. Is this a red flag?
On the surface, it absolutely looks like a red flag. But this requires an understanding of how executive compensation and securities law actually intersect. What we are looking at in these specific SEC filings is not an insider exodus, but programmatic selling.
Okay, so break down how programmatic selling works for someone who hasn't spent their weekend reading an SEC filing.
Right. So executives at this tier receive the vast majority of their compensation in stock, not a cash salary.
Right.
So if they want to buy a house or pay for their kids' college or just pay their massive tax bills, they have to sell shares. But because they possess material non-public information, they can't just log into a brokerage account and hit sell whenever they want.
Because that would be illegal insider trading.
Exactly. That would invite SEC investigations instantly. So they use what is called a 10b5-1 plan.
Oh, so they set up an automated schedule in advance.
Long in advance, months or even years prior, they tell a third-party broker, hey, sell 2% of my holdings every quarter on the 15th, regardless of whether the stock is at $100 or $400.
Interesting. So the timing is essentially blind.
Totally blind. The sales we saw from Valaga and Page were minor, fractional percentages of their total holdings executed on these predetermined dates.
Got it.
If we saw the entire C-suite dumping 40% of their portfolio simultaneously outside of a scheduled plan, yeah, that is a massive warning. But scheduled fractional sales are just executives taking their paychecks.
That completely changes the context. So if the insiders aren't panic selling, what is the institutional money, the massive hedge funds and asset managers doing right now?
The institutional order flow tells a very, very bullish story. When we look at the options market, which is where the big money places its leverage bets, we see heavy, sustained accumulation of call options, specifically at the 380 and 400 strike prices.
Right. Institutions don't sink millions of dollars into $400 call options if they believe the stock is about to fall off a cliff.
No, they don't. They are betting heavily that the momentum will carry it upward.
And retail sentiment seems to mirror that confidence. If you scrape platforms like X and StockTwits, the retail crowd is sitting at about 60% bullish.
Yeah, the sentiment is aligned. But, we really have to see how that heavy buying pressure translates to the actual technical charts. Sentiment can push a stock, but the charts tell us if the engine is overheating in the process.
Okay, let's map out that technical landscape. What are the charts showing us?
We are looking at a strongly bullish short-term uptrend. The stock bounced with real aggression from its March lows of around $293.
And right now, it is trading significantly above its key moving averages, right?
Very much so. The current price is near 398, but the 50-day simple moving average is lagging behind at 374, and the 200-day moving average is all the way down at 334.
Wow, so that massive gap between the current price and the 200-day moving average, that's the definition of institutional accumulation.
Exactly. The 200-day average represents the slow, steady consensus of the market over the last year. When the current price sprints that far ahead of the 200-day line, it means buyers are aggressively willing to pay a premium.
But doesn't that also create a structural vulnerability? Like, we need to look at momentum indicators, right? Specifically the RSI, the relative strength index.
Yeah, we have to look at the RSI.
Because currently, Broadcom's RSI is sitting well above 70. It's between 73 and 77. Now, an RSI over 70 is officially defined as overbought.
It is?
I like to think of the stock price like a car, and the RSI is the tachometer. Right now, that needle is at 77. The engine is revving deep into the red zone. Sure, it's going fast, but isn't it about to overheat? Are we seeing hidden short-term weakness beneath this massive momentum?
It definitely signals the probability of exhaustion. A high RSI doesn't mean the stock is fundamentally flawed or that the car is going to explode. It simply dictates that the buyers have pushed the price up so rapidly that a period of mean reversion is highly likely.
Mean reversion simply meaning the price needs to snap back closer to its historical averages, like that 50-day line down at 374.
Yes, exactly.
Hmm.
When a stock outpaces its moving averages by this wide of a margin, it usually have to either trade sideways to let the averages catch up, or it experiences a sudden pullback to test those lower support levels.
Right. But we also have to factor in the MACD, the moving average convergence divergence.
Me too.
Because unlike the RSI, which measures speed, the MACD is measuring the underlying trend direction. And right now, the MACD is sitting between 7.38 and 9.20, which is showing solid bullish momentum. And more importantly, there is no prominent divergence on the daily charts.
And that lack of divergence is key.
Why is that?
Well, divergence happens when the stock price hits a new high, but the MACD indicator starts dropping, meaning the trend is losing its underlying power even though the price is still creeping up. That's a classic trap.
Oh, I see.
But with Broadcom, the MACD momentum is confirming the price action. The trend is genuinely strong, it's just temporarily overextended.
Got it. But because it's overextended, we really need to know where the safety nets are. If this mean reversion happens, where does the stock find its floors? Where's the support?
So the absolute macro bedrock, the floor that would take a catastrophic event to break, is down near $310.
Okay, that's a long way down.
It is. But for the immediate term, the vital support levels to watch are 376.32, and then just below that at roughly 369.48. If the stock pulls back, those are the zones where buyers are likely to step back in.
And if the momentum just ignores the overbought signals and keeps running, what are the resistance ceilings?
The first barrier is purely psychological, and that's $400. Human beings and algorithmic trading bots are naturally drawn to round numbers.
Right, breaking 400 is a big deal.
Breaking and holding above 400 with high volume is a major psychological victory. If it clears that, the next resistance is the recent 52-week high at 414.61.
So we have a chart that is undeniably hot, facing a major psychological barrier. Yet Wall Street seems entirely unfazed by the heat.
They really do.
Analyst consensus is overwhelmingly a strong buy or buy, with average price targets floating aggressively higher, somewhere between $438 and $475.
Yep.
Which brings us to the core debate of this entire deep dive. Is Broadcom an undervalued powerhouse, or is it the ultimate value trap?
And the answer entirely depends on which timeline evaluation you are looking at. We are seeing a massive philosophical clash in how different factions of the market price this company, specifically surrounding the price-to-earnings or P/E ratio.
Okay, let's lay out the bear argument first, the negative signal. The skeptics are pointing to a trailing P/E ratio nearing 78 times earnings.
It's a huge multiple.
I mean, a trailing P/E of almost 78 times earnings sounds insane, paying $78 for every $1 of past earnings. To a traditional value investor, a P/E of 78 screams that the stock price has sprinted years ahead of reality.
Right.
Are investors paying a premium for last year's hype rather than next year's reality?
Look, if you judge Broadcom solely by its trailing P/E, it is undeniably expensive. It looks like a trap. But the bull camp counters that argument by looking at the forward P/E, which is sitting significantly lower, between 24x and 29x.
Wait, how can the valuation look wildly expensive and incredibly cheap at the exact same time?
It comes down to how markets perceive time. You can think of the trailing P/E as looking through the rearview mirror. It measures the current $398 stock price against the earnings the company generated over the past 12 months.
Okay.
Because the stock price shot up so rapidly over the last year, the historical earnings haven't had time to catch up in the rearview mirror, so the fraction looks bloated.
But the forward P/E is looking at the windshield.
Precisely. The stock market is a forward discounting mechanism. The forward P/E takes that same $398 stock price, but divides it by the estimated earnings for the next 12 months.
Ah. And this is where the sheer magnitude of Broadcom's $73 billion AI backlog completely alters the math.
Exactly. Because that $73 billion isn't a vague projection or a hopeful guess. Those are recorded, committed orders sitting in the pipeline, waiting to be manufactured, delivered, and billed.
So how does that $73 billion backlog factor into making this seemingly expensive stock actually undervalued?
Well, when you factor in the massive wave of cash that will inevitably flow into the company's accounts to fulfill that backlog, the earnings denominator in the P/E equation explodes upward.
And when the denominator gets that much bigger, the multiple shrinks.
Right, it shrinks down to a highly reasonable 24x. The bulls argue that if you look through the windshield at that guaranteed future cash flow, paying $398 today is actually buying the stock at a discount.
It is a compelling mathematical argument. But, a forward valuation relies entirely on the future actually unfolding as planned. And they're always landmines.
Always.
So let's pivot from the math to the specific real-world operations. What are the catalysts that drive the bull case to that 475 target? And what are the underlying risks that formulate the bear case? What's the worst-case continuation lower?
Well, the bull case, the best-case recovery scenario, is anchored by the quality of the clients inside that $73 billion backlog. Broadcom isn't just selling generic off-the-shelf chips.
Right.
They are deeply rooted in hyperscale custom silicon partnerships. For example, they co-design Alphabet's Google TPUs, the highly specialized tensor processing units that actually power Google's AI models. They have similar massive custom partnerships with Meta, too.
And the magic phrase for those partnerships is high switching costs.
Yes, absolutely critical.
Explain why Alphabet can't just wake up tomorrow and decide to buy their custom chips from a cheaper competitor.
Because of the engineering reality. Broadcom isn't just supplying a part, they are integrated into the architecture. If Google or Meta wanted to move away from Broadcom, they couldn't just swap out a chip like changing a light bulb.
Right. It's not plug and play.
Not at all. They would have to redesign their entire AI data center architecture from the ground up, rewrite the software stacks that communicate with the chips, and endure years of testing. The capital and time required to switch are so prohibitive that Broadcom essentially has these mega clients locked in.
And when you stack that unshakable custom hardware revenue on top of the massive recurring software revenue from the VMware integration, the bull case looks like an impenetrable fortress.
It really does.
But every fortress has structural weaknesses. What are the downside risks the bears are watching?
One of the primary warnings is a margin squeeze. We praised their elite 77% gross margins earlier. However, as the custom AI hardware side of the business scales up aggressively to fulfill that $73 billion backlog, it is actually putting a slight downward pressure on those overall margins.
Wait, selling tens of billions of dollars in new AI hardware lowers their profit margins. How does that work?
It comes down to the economics of hardware versus software. Software has a near zero marginal cost.
Right.
Once you write the code for VMware, licensing out an additional copy costs practically nothing, so the project margin is massive. Hardware, however, requires literal physical materials. You have to fabricate cutting-edge silicon in billion-dollar clean rooms, manage global supply chains, and ship physical products.
Oh, I see.
So as the physical hardware becomes a larger percentage of their total revenue pie, the blended profit margin naturally dilutes. Custom AI hardware yields slightly lower margins than standard software.
It costs more to build a physical chip than to email a software license. That makes total sense. Are there any other headwinds threatening the bottom line?
Yeah, there are tax headwinds on the horizon. Management recently guided that their non-GAAP tax rates will rise to roughly 16.5%.
What's driving that sudden jump?
Global minimum tax adjustments. The international community has implemented new rules to prevent multinational corporations from stashing their profits in low-tax havens.
Oh,
Everyone now has to pay a baseline minimum.
got it.
It won't break Broadcom's business model, but it is a bureaucratic drag that will impact their earnings per share.
But the real elephant in the room for the bear case is concentration risk. We talked about how locked in clients like Alphabet and Meta are, but that creates a terrifying vulnerability.
It really does.
It feels like running a phenomenal five-star restaurant where one massive VIP client, let's say Alphabet, comes in every night and pays for half the restaurant's operating budget. If that VIP client suddenly decides they need to cut their CapEx budget, isn't Broadcom highly exposed?
Highly exposed.
Why do everyday retail traders often ignore this downside volatility?
Because retail investors often fall into the trap of extrapolating current trends into infinity. They see hyperscalers like Alphabet and Meta spending tens of billions on AI infrastructure this quarter, and they subconsciously assume that spending will continue at that exact pace forever.
But corporate budgets aren't infinite.
Exactly. The true risk to Broadcom isn't a competitor stealing their clients. It's a sector-wide CapEx contraction.
What does that look like in reality?
Well, if macroeconomic conditions tighten, say interest rates stay higher for longer, or an AI monetization model fails to produce expected profits, those hyperscalers might decide they have built enough infrastructure for now.
And if they pull back?
If Alphabet or Meta slash their capital expenditure budgets, that $73 billion backlog might stop growing and future orders could evaporate. If the VIP clients stop showing up, the shockwave hits the entire supply chain. That's why retail traders often get trapped.
So taking all of this into account, the overheating technicals, the massive fundamental backlog, the locked-in clients, and the concentration risk, what is the actual outlook for this stock?
You really have to separate the outlook into two distinct timelines.
Okay, let's start with the short-term outlook, like the next few days to a few weeks.
In the short term, there is an elevated risk of consolidation or a slight pullback. The RSI is flashing overbought. The technical engine needs to cool down. Immediate price targets for this cooling-off period are likely to float between $385 and $405.
So expect some choppy water and sideways movement while the moving averages catch up. What about the medium to long-term outlook?
Long-term remains a story of incredibly strong secular growth. If Broadcom executes effectively on scaling their custom silicon, and if the hyperscalers continue their massive spending, the fundamental math of their forward P/E suggests the stock could easily push past the 440 mark by the end of the year.
So for someone listening right now, it sounds like two entirely different games are being played on the exact same board. The short-term game is incredibly volatile and highly susceptible to a pullback, but the long-term game is betting on the sheer, unstoppable momentum of AI infrastructure.
It is the ultimate duality of a market leader. You have an undisputed tech juggernaut generating incredible cash flow with the historic order book, but it's carrying a red-hot chart and relying heavily on a handful of mega clients.
It's a remarkable balancing act. And as a reminder to you, the listener, we explored these concepts today as an educational deep dive. We want you to take these mechanisms, the difference between trailing and forward, P/E, the overbought RSI, the concentration risk, and explore them further on your own.
The most successful investor is always the most curious investor.
We will leave you with this final lingering thought. Broadcom has built an absolute near $2 trillion fortress, fortified by a $73 billion backlog. But if just one of those major tech giants, say Alphabet or Meta, wakes up tomorrow morning, looks at the economy, and decides to pause their massive AI spending, does that unshakable fortress suddenly start to crack?
A fascinating vulnerability to ponder.
Keep digging. We'll see you on the next deep dive.